Welcome back. I'm Pierre Daly, managing editor at advisoranalyst.com, and this is Insight is Capital. Ilan Kolet, institutional portfolio manager in Fidelity's global asset allocation group, is here to talk about the questions he and his colleagues, Wolf and David Tulk, have been fielding most frequently from advisors and investors at the start of 2024.
This is the Insight is Capital podcast.
The views and opinions expressed in this broadcast are those of the individual guests and do not necessarily reflect the official policy or position of advisoranalyst.com or of our guests. This broadcast is meant to be for informational purposes only. Nothing discussed in this broadcast is intended to be considered as advice.
Ilan, welcome back. Happy New Year.
Thanks very much, Pierre. It's as always, it was a really enjoyable conversation last time, and looking forward to having another great discussion to start out 2024.
It's great to have you. It's only been a little over a month since we last spoke, and yet so much has transpired since. Chair Powell's about face, for starters, right?
Yeah, there's been a meaningful change, I think, to the expected path of monetary policy. For us, I would say the conviction in that is quite high in the U.S. It's led to a material change. It's led, I should say, in part to a material change in positioning around the U.S. and the optimism in the U.S. But the fundamental fact remains that for us, a high conviction view is the U.S. is going to outperform this year, and monetary policy doesn't need to be as restrictive as it's been for the last few years.
It was kind of a weird period because it was very anticlimactic. It happened very quickly. The market very quickly priced in six rate cuts, while the Fed has telegraphed only 3. So what gives with that? Is the market right, or have we gotten out over our skis?
Yeah, so the way I think about this, maybe this is a tough one to make as our first discussion point, but is we don't know, right? So investors don't know, and honestly, neither does the Fed or the Bank of Canada, right? So what do we know? That's kind of a useless answer. So what do we know? We know that with the significant improvement in underlying inflation in the U.S., coupled with the slow rise and slight drift higher in the unemployment rate, monetary policy does not need to be as restrictive as it's been. And I think the Fed, they probably won't admit this too rapidly, but the Fed was late to lift off. I don't think they want to be late to rate normalization. And so what I mean by that is, rates, like there were 525 basis points of rate hikes in the US. So let's say we're at around 5. The Fed moving from 5 to 4 or 5 to the high 3s is them becoming less restrictive, right? That's not a reactionary cut to a spiking unemployment rate or growth falling off a cliff. That's the
Right.
That's the Fed recognizing and being data dependent, as they've said, and recognizing, look, the 6-month annualized rate of core PCE inflation is 1.9%. The unemployment rate has drifted higher. The labor market is less tight. We're seeing progress on inflation. Rates don't need to be as restrictive, because if we keep things restrictive with this improvement, the longer you're restrictive, the more restrictive you are, and you run the risk of sort of squishing the consumer, the housing market, business investment, and maybe this little productivity boom that we think we're in the midst of in the US. So rate cuts are the right move. And again, anyone who has precision around specific dates or by how much or where the landing point is, I would really fade all of those sort of talking heads about specifics on rate cuts. The truth is the
Right.
Fed doesn't actually know where the landing point will be or the cumulative amount of rate cuts that we'll see in 2024.
Yeah. So, in a way, they've definitively called a pause. They've sort of, it seems like they've definitively, brought up the subject of taking their foot off the brake, maybe as well, and that we'll have these rate cuts at some point in 24. There's also some concern. It creates. The uncertainty hasn't gone away, right? And so, if anything, some voices in the market are talking about, inflation volatility, that taking the foot off the brake could actually cause a resurgence, rather in inflation or inflationary pressures in certain quadrants of the economy. And given that, I think, one of the first question in your white paper that you recently released this past week was, the case for why investors should consider, balanced mandates or asset allocation funds, tactical asset allocation strategies in this market rather than taking a seat at the sidelines in cash instruments or GICs. So why would you stress at this point favoring balanced or asset allocation mandates at this time versus just taking the easy 5 or 6% that's available at the bank or in the market through T-bills?
Yeah. So Pierre, the reason this was question one in this 11 questions for 2024 paper is because it's the question that I answered, I don't know, 8,000 times a week last year. And that every
Why should I do
advisor
that?
and that every advisor who's listening to this call answered a lot of questions around this. And, investors flocked naturally to GICs because they got rates of return that they hadn't seen in decades. So
yeah, sure. It's the easy low-hanging fruit. I don't have to take any risk. I can just get this risk-free rate of 4, 5, 6%.
Exactly. Exactly. And so,
not hard to understand, right? I mean, it's risk aversion sets in after 1.5 to 2 years of pretty rough markets.
Exactly.
And unpredictable. Missing the rally, for example, at the beginning of the year, was something that upset a lot of people. Quietly upset them.
Right. And so I think the combination of 2022, right? So 2022 from a stock bond environment, because of elevated inflation and inflation volatility was, and we discussed this in the past, was sort of down and downer, right? So the combination of the bad taste in the mouth of 2022 coupled with historically elevated guaranteed rates of return led to all sorts of investors, not just the risk averse ones, plowing into GICs and those types of term investments. And for the downside protected investor, it's a natural decision to make, right? Especially if you have some excess liquidity and you just want to park uncertainty and park capital. The argument that we make in the paper in question one is around the longer trade-off between risk and return, right? And so in the first paper, in the first question in the first paper, we have a chart showing, your experience over the past 10 years in a GIC. $1,000 in a GIC over the last 10 years is just over $1,100 at the end of 2023, and it's $1,900 if you were in our global balanced managed portfolio, a globally diversified 60-40 with great underlying managers, and us leaning in or out of asset classes, styles, sectors, and currencies. Now, it feels a little silly at times to compare a GIC to a 60-40 stock bond multi-asset class fund that's globally diversified. So the other thing we did is we said, what if the investor, the Canadian investor, had a 5% GIC every single year for the past 10 years. So again, this is a purely hypothetical case. And even then, that is $1,600 versus the almost $2,000 that $1,000 would have become in our funds. And then the second chart that we show, which is again a little bit nerdier, is a scatter plot. I mean, as a nerd, there's nothing I love more than a good scatter plot. And that scatter plot just shows that risk and return trade-off between, again, all equity, all bonds, a GIC, and then various multi-asset class funds. So again, for the medium to long-term investor, I think a well-diversified multi-asset class fund makes the right sense. But I'm completely sympathetic to the investor that suffered in 2022, that wanted safety, that wanted to park capital and put money into a GIC. I think what's interesting now for advisors, and this came up in recent conversations throughout Ontario and BC, is some of those GICs for advisors clients are now maturing. Where's the next step? What's the next step? And that's, I think, the interesting conversation, and where this question one in this paper will be really, really helpful in exploring those options for the medium to long term.
Right. Yeah. I mean, given that you're like, we've got all these biases that we have to constantly contend with, right? We have to contend with ourselves and our inability to make the right decisions at the right moment, at exactly the right moments, and that's the danger of being invested or uninvested. Either way, you're taking the risk. With GICs, with paper, cash, it's the reinvestment risk, right? It's that by the time you reach the decision-making point, you might have, you might find yourself facing lower rates, and then the dilemma of also missing out on the positives that are happening in both the bond market and the equity market as a result of falling rates. And so you don't want to position yourself out of the market, but you want to position yourself in a way to continue to participate, and also not find yourself at that intersection where you have to make a decision about reinvesting and then not knowing what to do once again. That turn of the year at the beginning of 24, when the Magnificent Seven began to rally, and if you were in U.S. equity exposure, you would have caught that. But if you had been risk averse because of the previous year's business activity in the market, you would have completely missed it. And by the time you realized, I gotta turn things around in my portfolio or turn things over, you start to feel that angst of missing out, right? Having missed out, as opposed to FOMO.
Right. I mean, I think advisors, one of the very difficult jobs that advisors have are those difficult conversations around various life events. I'm sure those are exceptionally difficult. But the last couple of years, I'm really sympathetic to the advisors that I speak to and reach out to, and that we help, in terms of the oddity of the market, right? So the COVID shock, the resulting inflation shock, the destruction or erosion of stock bond correlations, right? So it's been a very, very tricky time, which for the advisors who are listening shows up as really, really difficult conversations. And so this paper, I think, really attempts to help advisors sort of arm them with some techniques or some questions to engage in these difficult conversations. The other thing I mentioned, Pierre, is we also, in our multi-asset class funds, have access to cash-like instruments, right? So the short-term allocations in our funds, I kind of think about those as that's what we call cash. I mean, that has access to that yield pickup.
Right.
That was one of the large overweights that we had in 2022. We had a high conviction view that short-term rates were going to move higher. We had 8 or 9% of our 60/40 sitting in cash, which again is uncharacteristic. I mean, investors buy our funds to be fully invested, not to hold 9% of it in cash. But we held a large share of it in cash because it was a sensible thing to do. So that there's some similarities there to that GIC motivation. I think we've moved away and out of that environment now. And again, I mean, we were discussing this before, but we're outright optimistic on the US. I'm excited about what we're seeing in the US. It's almost uncharacteristic for me to sound this positive. I think my family's a little bit thrown off, but again, there are some exciting things happening right now, I think, in the US, and we're taking advantage of that with tactical overweights to US equities.
Yeah. I think I just wanted to recap something that you said in our last conversation, which I thought was one of the highlights of the entire conversation, because, I mean, at least for me, it was an insight. And that was the fact that you said that inflation, these bouts of inflation, what's particularly dangerous about them is the way in which they affect the correlation between stocks and bonds, or erode the correlation, where everything has a correlation of 1. And I thought that was actually one of the great insights of our last conversation. I'd never heard that before. I've never heard, I mean, it's been so long since we had inflation, but I had never heard it put quite that way. And I just wanted to, give you a nod.
Yeah, no,
Give you a nod on that, I think.
So again,
Yeah.
like I've spent, I don't know, more than 20 years thinking about inflation from the time I started at the Bank of Canada to my time at Bloomberg News to being the head of inflation and commodities research down in Boston on our asset allocation research team. A lot of the times when I'm talking to advisors and institutional investors, I think we have to move past this notion of inflation, and I don't want to diminish it. We know that inflation erodes the purchasing power of every dollar we have, right? So if grocery prices are up 20% and eating out is up 20% and used cars are up 40% and our wage has gone up 10 or 12%, we're worse off. I think we all understand that. The reason we should really care as investors, right? So investors listening and the investors that I speak to is because of what it does to that stock and bond correlation. Again, right. in the multi-asset class strategies, like this is a founding principle to the stock bond mix, right? That we all know and love. And one of the things, I can't remember if I mentioned this last time, but I used to talk about it, and I had a chart showing the 1970s, right? So if you were in a 60-40 in the 1970s, I mean, you had kind of a lost decade from a rolling return perspective, because it was, again, down and downer, unless you owned the land that produced the commodity or, had a bunch of commodities sitting in your basement, because they were uninvestable. It was a terrible period. And that was because that elevated rate of inflation had eroded that stock bond correlation. So I used to talk about the 70s as a great example of that, but now I talk about 2022 as a great example of that, right? So there's been some improvement there, but no, that's the reason we should care as investors, and it's a really important point, and one we protected against. But again, in 2022, we protected against it, and we preserved basis points from a relative perspective. But preserving basis points from a relative perspective, I have learned, is not the way that advisors, clients think about their portfolios, right? They see red on the statement. They don't see less red than the benchmarks, right? So I'm sympathetic to those conversations, those hard conversations that advisors are having.
Yeah. So Ilan, I think you already touched on your highest conviction, or at least one of your highest conviction overweights, but talk about those high conviction overweights that was the next question. The next two questions are what are your highest conviction overweights, and what are your highest conviction underweights? So maybe
sure,
talk about that as we enter this year.
Yeah, I mean, maybe I'll do the underweight one first, and then I'll pivot to the positive one, so we kind of end the question on a positive note. But so we still have meaningful concern around Canada. We think that exceptionally high rates of household debt intersecting higher borrowing rates, even if the bank cuts in the back half of this year, right? Mortgages are not going to be renewing at rates that people were getting pre-COVID. We think that's going to spell some trouble or some problems for the Canadian macroeconomy. And we think that's going to show up as relative underperformance in Canadian equities, right? So our highest conviction underweight right now, again, is around Canada. And there's a few points I really should make on that, just to clarify things. So we're underweight Canada, Canadian equities, Canadian fixed income. We're meaningfully underweight the Canadian dollar, because we think it's one of the first valves that will get the pressure release valves that will get released in the event of this stress actually showing up in headlines and sentiment, right? We'd see a depreciation of the Canadian dollar. If we're underweight the Canadian dollar, our portfolios get hurt less. And so in the paper, one of the things we talk about, though, is it's kind of interesting. We do this on a look-through basis. So we're underweight Canadian equities, but if you look through to the underlying managers that we're using in Canada, they're underweight the Canadian banks, right? And so which is a very sort of contentious or controversial thing to talk about,
Right.
because for many, many Canadian portfolios, Canadian investors, Canadian advisors, Canadian banks have been the cornerstone of those portfolios for 20 years. What I would say is, and we get into this in the paper, is Canadian banks have done well, I think unsurprisingly, in a credit and housing boom, right? So where has Canada been for the last 20 or 25 years? In this giant, expanding, overtaking credit and housing boom. And it's unsurprising that the lenders of those mortgages have done well, right? And so I think that's an interesting, right? That's an interesting perspective. The one nuance I would make here, I would clarify here, and this is something I don't think I did a good enough job on when we spoke last time, or even in some of my previous conversations, is even if Canada underperforms, say, the US, if the underlying managers that we use in our strategies outperform their benchmarks, right? So they choose bank A instead of bank B, or resource company A instead of resource company B, and they beat their individual benchmarks, we still win, right? So, like we talked about this in our last conversation, there are really two layers, right? So hire a great team, use a great team of underlying managers and let them follow their research process to beat their benchmarks. And if we own them, they boost us. And then the other thing, which will link to our highest conviction overweight, is lean in or out of asset allocation sectors or geographies to add value as well. And that sort of brings us to that highest conviction overweight and optimism, which is around the US, right? So in the paper, we talk about it as an overweight to the US dollar. But really, I think, the most meaningful change now versus the last time we spoke, Pierre, I think the last time we spoke, I probably said we're roughly neutral beta, right? So the 60-40s are sitting very close to 60 and 40. We're now overweight equities, and that is almost entirely because of a change in view around the US. So the last time we spoke, we were underweight US equities. We're now outright overweight the US equities. And that change in view is always going to be research motivated, but it's motivated, I think, from two main areas. The first is the increased likelihood of a soft landing in the US, right? So we probably talked about this last time. I might have hinted at it, but the likelihood that the US achieves a soft landing has materially increased and is now my base case. And again, I can almost feel the collective eye roll from everyone listening right now. And most folks are probably too polite to do that, but again, with 525 basis points of tightening in the US, it would be pretty unusual and rare to achieve a soft landing. But I think the soft landing will be achieved for two reasons. The first is the US is less interest rate sensitive than it's been in a long time, perhaps ever.
Right.
And that's because levels of household debt are lower, right, than they were, say, pre-financial crisis. And a tremendous portion of American homeowners refinanced their mortgage pre-COVID. Again, we probably talked about this, but when I lived in Boston, 2014 to the middle of 21, I had a fixed rate mortgage for 30 years that was 2%. And everybody on my street refinanced their mortgage pre-COVID. And I knew this because they knew I was an economist. After dinner, I'd walk the dog. And over an 11, 12-month period, everyone asked me, is now the time to refinance my mortgage? So I would take out my phone, open the very useful St. Louis Federal Reserve app, which maybe I'm the only one who has that downloaded, and show them the chart on the 30-year conventional mortgage that's a straight line down, and ask them, how much lower do you want this to get? So that's the first point.
I think for Canadians, that would be like a dream scenario, to have a 30-year mortgage fixed at 2% would be like, you what?
Yeah. And, right? and another thing we talked about, Pierre, last time was this wonderful perk of mortgage interest cost deductibility, right? Which is like, it's a gift. It's a little perk and a gift. And it's
Absolutely.
not little, actually. It's a pretty meaningful perk. So the first one is
it covers half of your payment. I mean,
yeah, it's
right. It covers half of your interest, basically.
Yeah, it's
If you're in the highest bracket, you know,
Yep.
you're gonna get that back and put that towards your mortgage.
Right. You know,
Like
it's
the Yeah.
yeah, it's a strange one, right? Because it's a perk for homeowners who already are at the income spectrum or part of the income spectrum that can afford housing. It's very contentious. There's been a lot of research on it. Sorry, not very contentious. There's been a lot of research on it around the equitable results of that. But you're absolutely right. It's a perk. But the interest rate sensitivity one is the first reason we're overweight and optimistic on the US. The second one is actually something that I'm really excited about. And it's the likelihood that the US is in the midst of a little productivity boom or a
Right.
productivity cycle. And so, you know, you can imagine advances in artificial intelligence or investments in clean technology or households and workers optimizing their work-life balance a little bit better has led to an increase in the stall speed or the potential growth rate of the US economy. If that's the case, then inflation can continue to fall like it has been. Again, 6-month annualized rate of core PCE is 1.9. The labor market can remain at historic lows. Earnings can do well. Equities can do well. And the US can do exceptionally well. So it's like a checklist on
Right.
the optimistic bullish scenario for the US. And something that I think is very plausible and a motivation for why we're overweight US equities right now. I mean, it's a pretty great scenario. And again, there's some eye rolling happening right now. I can feel it, but this has actually happened in the past, right? So in the mid to late 90s, we had the advent of the internet. It changed business processes really significantly. The recession models that we were using in the mid to late 90s were flashing red, similar to the ones that we have now. But we never got that recession because the stall speed of the US was just that much higher, right? And it was if we all remember, mid to late 90s was a pretty great time, right, for earnings and equities.
Yeah. I recall listening to Ken Griffin in one of his appearances on Bloomberg talking about how, I mean, he was asked, what do you think is what do you think is one of the most misunderstood, basically one of the most misunderstood aspects of the market right now. And his response was a surprise at the moment because 60/40 investors had basically gotten pummeled for the last couple of years. And he turned around and he said, now is actually a really good time in the market for 60/40.
Yeah.
And he basically, all he did was he flipped the script, right? He just turned everything that people were feeling upside down and into an opportunity. But he was, looking back on that flipping of the script, he was quite right. And it was anybody who sort of glommed onto that idea, it was quite a fortuitous moment as well to have heard that, and it's another thing to act on it given how we felt. But I'm curious, after we've had this very sort of rough period for the bond market because of these 525 points in rate hikes, is this a comeback year for bonds?
Yeah. So again, I always think about things, Pierre, as you know, in the context of monetary policy, the Fed and the Bank of Canada. I mean, I do think we're certainly at the end of rate hikes. I think the likelihood of a push higher in rates is very, very low. And again, I'm looking at exactly the same data that everyone who's listening right now is looking at, which is the same data set that the Fed and the Bank of Canada are looking at, right? There's no magical data set that we don't have that they have. And so the likelihood of rate cuts this year, again, is quite high. We don't know cumulatively by how much. What we've done in the funds is we're basically neutral in terms of duration right now. We think the better place for us to enhance the expected return of our funds is being opportunistic in some parts of the equity market. And on the bond side, again, we've pulled in some of the underweights to investment grade debt, but we remain overweight on the credit and the spread sectors, right? So the leverage loans, the high yield, the global high yield, these are areas where we continue to be overweight. And where we think we can enhance the income side of the portfolio. That said, again, I I think what it would take for us to really change our position and our view on duration is a return to a more normal correlation environment, number one. And number two, we need to be a little bit closer to the actual normalization in monetary policy. Again, and this is going to be a bit nerdy, but if we're at 5 right now, I mean, surprise, surprise, right?
Yeah.
If we're at 5 right now and neutral is 2.5, there's a tremendous amount of way to go, of runway for rate cuts. If that said, and that explains some of that sort of exuberance that bond managers and bond investors are thinking about. Wow, we're at 5 and we have to get to 2.5. That's hugely optimistic. If the productivity growth and potential growth story that I just outlined in our previous discussion, or in the previous question, is actually happening, the trick with that is it means that neutral is not in the low 2s, right, or 2.5. It could mean that neutral is in the low 3s, which means the gap between where we are now and neutral is a little bit smaller, which allows us or makes us think maybe we should pump the brakes a little bit on that bond optimism, right? So this is something, again, that we answer in this paper, but thinking more holistically in terms of the full fund, and again, our overweights will reflect conviction. This conviction in the overweight to equities, specifically in the U.S., is sort of front and center for us right now.
Just reflecting on, the way that you're going about managing your asset allocation strategies, your asset allocation mandates at Fidelity. It's interesting to point out that while you have a negative or a less optimistic view rather on Canada, you're not divesting Canada. You're just investing less relative to the other opportunities that are out there.
That's probably one of the most important takeaways from our conversation today.
Yeah.
And something, again, that I think is easy to get lost when we talk about caution in Canada. You're bang on with that point, right? So the 60-40 that we manage, the global balance 60-40, 21% of the equities in the 60 are Canada.
Right.
We're just shaving it by 7% because we think there's going to be relative outperformance in other areas of the world or markets versus Canada. But exactly like you mentioned, Pierre, those underlying managers that we're using in the Canadian sleeve of our Canadian equities in our funds, if they beat their benchmarks, again, which historically they do, they boost the overall performance of the fund. That's a very, very important point that, again, I think sometimes it gets a little bit lost because we're talking about this 3-dimensional matrix, which is sometimes difficult to explain.
Well, and the role of advisors is very challenging because of expectations that clients have of the advisor and vice versa, getting, advisors' challenge of getting the client on board with any idea. And especially, in the midst of risk aversion that we've had for the last couple of years, inflation. I think the benefit of being in a single ticket type of situation where your whole portfolio, an entire portfolio is planned out and executed by your team and by the team of portfolio managers behind the team, the different layers that we've talked about. You have all these things are happening very dynamically. You don't have to, an advisor doesn't have to figure out, should I overweight the U.S. or underweight the U.S.? Should I overweight Canada or underweight Canada? Should I cut my holdings in bank stocks or increase them? Or, should I increase my duration in my bond ladder? Should I, these are all, it's all theoretically something you can think about and process in your own mind as an advisor or as an investor. That's just one thing, but the other part is execution.
Right.
The execution is the part that's the hard part, the really incredibly difficult part. Like, investing is simple but not easy. Right? It's what's the Einstein quote is try to make things as simple as possible but not too simple.
Right, exactly. So Pierre, I mean, again, this is another really critical point, right? So I sometimes think about the portfolios that we're managing. I often say are simple and elegant solutions to really complex problems, right?
Exactly.
So diversified across managers, across the globe, across styles, across sectors, rebalancing. Again, there's a lot of ways to win here, right? So you assemble the great team who are all motivated against their own individual benchmarks, and then we do the asset allocation, right? Which areas of the world and asset classes are going to outperform on a relative basis, and we do the rebalancing. And so, these two ingredients to success, they don't work necessarily perfectly every day or month or sometimes even every year, but the long-term track record of the process that we followed in our multi-asset class funds has a proven sort of track record of success. So, in terms of peers beaten and in terms of returns. And it's not just the 3-month or the 1 year, right? It's the 3, 1, 5, 10.
Right.
And that wedge between just a blindly passive 60-40, which for most Canadians is probably too heavy in Canada, is giant, is huge. It's like 30%, right? Over 10 years. And so, again, there's a reason why, like, these are easy conversations for me or enjoyable conversations. I shouldn't say easy, because I personally have a high conviction view in our process and what we're doing. I'm personally, obviously, linked to the performance of the funds, but I'm also invested in them, right? And I sometimes joke, like, I get thousands of difficult questions from advisors from across the country all the time through their sales folks. But one of the hardest conversations I had to have was when my father-in-law, my 81-year-old father-in-law, sold his principal residence of 40 years and needed some advice on what to do with the proceeds of that home, right? So, I mean, the conversation I'm having around our portfolios related to that father-in-law nest egg is really the putting the feet to the fire.
Yeah. Execution.
Exactly.
Making sure, like, when you have, when you have as many, like, one person or one team, like one advisor team or one person, I think is hopeful that they can make all those decisions. But there's a real risk of being underinformed at any given moment, not having all the resources that are required to make those choices. But lastly is still that big nut to crack, which is execution. Like how to make a portfolio happen. When you can actually rely on an entire organization to carry out those instructions and those execute those trades. To me, it solves a huge problem.
Yeah,
like,
and
looking at that.
Absolutely. And Pierre, so this is the benefit of scale, right? So we manage roughly $80 billion in assets for Canadian investors in our multi-asset class funds. We report into an organization headquartered in Boston, where we're there quite regularly. I used to live there, work there, that manages $900 billion for global investors. 700 of that 900 billion are the U.S. Freedom Funds, right? These are the flagship Fidelity Freedom Funds for American retirees. I can't remember. I think it's 1 in 5, 1 in 6 Americans in some way touches these funds. But the reason I mention that is not to impress people with 900 billion, although it is. The reason that's an important fact is we use the same infrastructure, the same portfolio analysts, the same risk metrics, the same quantitative support, dedicated asset allocation research team. We're using the same resources that $700 billion sort of behemoth is using as well. And those are the benefits of scale, right? So, like, when I get asked questions like, when are you forced to rebalance your funds? The answer is whenever we want. Right. When are you forced to, if you want to be overweight the US, when can you do that? The answer is whenever we want. If you don't have access to a capability and you want to add it, when can you add it? And guess what the answer is? When we want, right? So if there's a capability that's being built or developed in the US, we're in those conversations, right? And so this happened, I think, 7-8 years ago with the inclusion of, probably the most well-known, one of the most well-known U.S. equity managers, Will Danoff, when we added
Right.
him to our strategies. Right, we added him because he was a building block that we wanted to use as an advantage in our funds. It's the same sort of thing with new asset classes, new managers, new capabilities, new risk models. Right, we're in the conversations at the table in terms of the development and implementation, and that's an edge. Like, to be quite frank, that's an edge. We have a really nice chart that I'll share with you.
Yeah.
After our discussion, showing, it's really neat. It's a time series chart over 10 years. It shows the Canadian TSX. It then shows the Canadian sleeve of our global balanced fund in another line, which has handedly outperformed the TSX, as we would hope. But then what it shows is we have a whole bunch of gray lines. It's kind of a spider chart showing the underlying managers that we're using in our Canadian sleeve, right? And the advantage is, not only are we beating the Canadian TSX, I mean, that we better be doing, but the second thing, the second thing to note is the volatility that exists in underlying Canadian equity managers is being smoothed by combining them, right? So, we're smoothing the Hugos and the Dans and the Dons and the Marks. They're getting smoothed out by us owning basically all of them in various sizes. And each size is calibrated and done in a very deliberate way. But again, this is the benefit of one of these research-based multi-asset class solutions is, we can have a conversation that spans everything from like supply chain issues and supply disruptions all the way to Canada, all the way to how we're thinking about an AI dividend. And all of these ideas, right, from every topic under the sun are sort of implemented and being thought about in our portfolios by the managers, by us, and by all of the hundreds of analysts spread across the globe that Fidelity has. So again, there's no substitute for strong research. I'm a long-standing research nerd, and there's no substitute for high-quality research. And research does underpin every single thing we do in the fund, from the inclusion of the manager or the asset class, the construction of the underlying fund, the long-term things we're thinking about, and then the tactical overweights and underweights, which is mostly the subject of this paper. The last thing I wanted to mention is, I get all sorts of questions. The last question in this paper is, will the US dollar lose its reserve currency status? So originally that wasn't going to be in the paper, but I really wanted it included because this is a great example, Pierre, of a notion or a subject that gets broadcast, in popular media or in news or in blogs or on Twitter or whatever they call Twitter now. And when you actually look at the chart and look at the data and examine it critically, it's way overblown. Right. And so, I mean, the U.S. still accounts for a giant share of foreign exchange reserves. We have a great chart in the paper. And this idea that, the U.S. dollar is about to lose its reserve currency status and investors get worried that then they then call their advisor and then the advisor reaches out and to us. I mean, this is a great example of this disconnect between sort of reality and sometimes what takes over.
So I before we wrap, let me just let's end off our discussion on, again, just I want to stress that you're not investing in Canada, first of all. But given the outlook, obviously, Canadian investors, advisors, I think we should definitely cover what your thoughts are on when the Bank of Canada will cut rates.
Sure. Yeah. So how are we thinking about, the bank cutting? To answer this question, we really have to come back to inflation again, right? So we had an inflation print in Canada a couple of days ago. It showed that total and core inflation in Canada remains in the threes, right? So there has been improvement on the rate of inflation in Canada, but I'll say it has admittedly been less convincing than the downward trend in the US. And so while the downward trend in the US on core inflation has been meaningful, we have a really nice chart in our paper on this. That leads to the idea that the Fed doesn't need to be as restrictive as they are. In Canada, it's a little bit less of a slam dunk, right? So in Canada, the progress on inflation for a number of reasons has been a little crunchier, a little bit stickier. But there has been progress, and the bank does not need to be as restrictive as it has been through the period of tightening and for most of last year. I think we're going to probably see the bank change its stance, and this will first come through in the language, and we'll talk about that, towards the middle of this year into the end of this year. Again, we don't forecast individual meetings because we don't really think that that's very helpful. But the way that we are thinking about monetary policy, both in the US and in Canada, is by the end of this year, it won't look as restrictive as it has been. A couple of clarifying points, Pierre. First, a move from 5 to 4, let's say we're at 5 and we move to 4, that's moving from very restrictive to restrictive, right?
Right.
But the bank is, and that's not stimulating, right? The bank, that's just less restrictive. The bank is well aware of the excesses in the housing market, the stretched level of household balance sheets, and the fact that in 2023, the Canadian economy did not grow at all, right? So Canadian GDP was a flat line, and in per capita terms, given the surge in population and immigration, in per capita terms, growth has fallen, right? GDP growth has fallen per capita. So it's not a great picture already in Canada. And so the bank needs to be very, very careful about not sort of imploding the Canadian household, the Canadian housing market, and Canadian businesses and Canadian capital spending. That said, they still need to see sustained and consistent improvement on underlying inflation, because that's their only job. That's the only job.
Right.
And we've seen quite a bit of that, but we need to see some more of that. And then the last point is they will take us on a leash to BOC day, to Fed day, on what they want us to think, right? 25 cut, no change. And they will do that in speeches and communications and monetary policy reports that come between interest rate decisions, right? So what we will see is we will see the language evolve, right? Just like we saw Powell's language evolve at the end of last year, we'll see Governor Macklem and the deputy governors come out in speeches across the country and in media interviews and slowly start to sort of guide and change the expectations that we're seeing. We haven't seen that much of it in Canada. Right. We've seen a measurable change in the US, but I expect in the next couple of months we'll start to see this in Canada.
I think it's probably something that most Canadians are sort of holding out hope for will happen sooner rather than later. Where is inflation heading? I think there's been some talk of inflation volatility, and
right.
What are your thoughts on that? I think, and some of that may be addressed by the fact that the Fed is only telegraphing 3 cuts versus the market's jump to 6. So is it somehow factored in the differences? The concern that cutting rates could cause a resurgence in some quadrants of the economy, inflationary surge, like inflation volatility, and like you cut rates and then inflation comes back, and then you have to hold off on the next cut, or you might have to raise again.
Yeah, I would say.
What are the odds of that?
So I think they're low, but not impossible, right? So what do we know? We know that through the pandemic, this is all stuff we know. In the pandemic, we were locked into our houses. We could only buy goods prices, and there were fewer of those goods because of the supply chain shock. Goods prices went straight up and really boosted inflation. The goods price shock today is gone, right? So goods are now inflating at pre-COVID rates. Cross goods off the list as an upward contributor. And again, we have a very nice chart in this paper showing the contributors from goods and services. What we're left with are service prices. So services, the price of a service is determined by the price that you pay the person doing the service, right? So contracting, electrical services, guess what? That's the price of that contractor and that electrician. And they're a lot more expensive because unemployment rates are low, right? And there's just a scarcity and more demand, and that's pushed up wage growth, which has pushed up service prices. what we have seen, especially in the US, is service prices have slowed. Right, they're not deflating, but they're
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 just not
not
going up as
declining,
quickly.
but
Yeah.
they're not going up as quickly, and
Right.
service prices have slowed, and that's why the 6-month annualized rate of core PCE is 1.9%. To your question, Pierre, this idea that if we get declines in rates in monetary policy, does this lead to a resurgence in inflation? There's been a lot of lessons learned from global monetary policy and central bankers from that episode in the 80s when exactly that happened, right? So when the Fed was too quick to cut, and then there was that hook higher. This is why you're going to see the move. It'll be quite glacial.
Right.
It'll change. First, the language will change. Then they'll take us on the leash to the Fed day, right? And it will be quite glacial. That said, they don't want to be too restrictive for too long. Again, if you're moving from call it 5 to 4, you're still restrictive. You're just less restrictive, and you have to recognize the improvement in inflation, the drift higher in the unemployment rate. Drift higher in the unemployment rate should correspond to less demand, less wage growth, less service prices, right? So I would say it's not impossible to see some of the categories tick higher, but in general, inflation, especially in the US, is convincingly heading in the right direction, and rates just don't need to be as restrictive as they've been.
Amazing. It's been great having you. I've really enjoyed our conversation today. Thank you very much for agreeing to come back and to cover your most recent white paper, which everybody should read. It'll be in the show notes below. And Ilan, if advisors want to find you, what's the best place to find you?
We have an incredibly talented and gifted set of a sales team, right? Fidelity wholesalers. Anyone listening will have someone that they can access on the sales side, right? That can link them into the papers, the podcasts that I do, the webcasts that I do. I speak from coast to coast,
Right.
and I love that. So I'm certainly available. The best point of contact again is that Fidelity salesperson that all the advisors on this call should know, and if they don't, they should get to know.
Awesome. Ilan, thank you so much for your incredibly valuable time and your insights today. It's been great having you. I hope to have you again very soon.
Thanks, Pierre. Yeah, happy to do this anytime you'd like.